Okay, good afternoon, good morning, good evening, wherever you are, and welcome to the Affinity Exchange. And this is, I think, the second one we have in our series, right? And today we have a very, very special guest with us. Some of you who have watched our first episode, you know Vincent, but just for our newcomers, right? Let me just do a short introduction of Vincent. Vincent is an executive wealth manager from the Affinity branch, which is part of the Infinity Financial Advisory firm. Now, he has a deep passion for investing and started dabbling in the stock market since 14 years old. I was just playing games then. He has been in the industry for close to a decade and is a big believer of upgrading himself. That's why he has the following accreditations under his belt, such as Certified Financial Planner, Chartered Financial Consultant, Certified High Net Worth Advisor, Precept Estate Planning Practitioner, and Certified Life Underwriter. Wow, many, many papers. So this is Vincent. Vincent, you want to add anything to your introduction?
All is good. Thank you.
All is good.
Yep.
Yeah. I mean, people will be seeing you over and over again.
Yes, that's right.
But this time, I think we are here for the big man over here.
Yes.
Ladies and gentlemen, if you are wondering where his accent is from, I wondered that myself earlier. He shared with me that he is Scottish. In fact, Indian Scottish, right?
That's correct.
So let me just read out his introduction over here. Amit Moudgil is a fixed income investment specialist and is responsible for supporting the commercial growth of the fixed income franchise at Aberdeen. Amit joined the company in 2006 from State Street, where he was a performance analyst. Amit initially held the role in the UK equity team before moving into an investment analyst position within the distribution function. Amit was then appointed as the fixed income investment specialist, supporting the EMEA business before moving to Singapore in 2022 to join the Asia Pacific fixed income team.
Yeah, I mean, I think it was a great introduction, and thank you for having me on the podcast. A little bit more about myself. I guess when I joined the company I'm in, I've been in the company now for over 19 years, so quite a long time. But having had the progression throughout the company in those different roles has been very fruitful. I would say that role within the distribution function was pretty eye-opening for someone who'd come into the industry new. I was able to go around all the different asset classes, so learn a lot about different asset classes, whether it was equities, real estate, but latterly I was focusing on fixed income, which is why I then aligned myself to that as a career, and I'm a fixed income investment specialist, and I'm now in Asia. I have kind of two hats that I have to wear. I have to very much support the Asia Pacific fixed income team and what they manage here in Asia, but I also have to have the other hat on to ensure that our global capabilities are promoted and also supported to any client opportunities in the APAC region as well. So I have that remit.
All right, thank you for that. I think some of our friends, especially for people who might be new to investments, you're wondering, what is this fixed income? In fact, it is a sort of asset class, right? Yeah, and there are many different sort of asset classes. What Amit has mentioned, getting the exposure, different sort of income, this sort of different sort of funds, asset classes, right? Before we go into that, because it all falls under the umbrella of unit trust, and unit trust is something that Vincent, I believe you are very familiar with. So tell us, for those of us who are new to investments, can you share with us what is a unit trust?
All right. Thank you, Jackie, for the question. So I believe most of us, if let's say we are new to investing, unit trust could come as a very new term. So what exactly is unit trust? Basically, you can think of it like, for example, if Amit here is a fund manager and I want to invest, but probably my capital is limited. At the same time, I want to diversify into the different instruments or the, say, for example, companies for simple discussion purpose. Say I want to invest in the top 500 companies in the US stock market, but I don't have that much money. So probably if that's my case, I'll piggyback together with probably some other friends and pass my money to Amit, and Amit, being the fund manager, will help me to invest and select the stocks from there.
In a way, it's like because sometimes we do not have enough resources.
Yes.
We might not have access to some of the better options out there.
Correct.
Right?
Or say, for example, maybe I just started working. In order for me to buy into, say, for example, Netflix stock.
Yep.
Right now, it costs maybe about 1,000 plus, if I remember the stock price correctly. I need to plow out at least 1,000 plus USD to invest in just one Netflix stock. But for the same amount of money, if I were to invest with Amit, probably Amit can help me to choose the top 30 or top 50 companies that are really very strong, and I get immediate diversification with that same capital. Yep.
Okay, wonderful. I think then we come to the question. I was also wondering myself, because I'm not a person who's very familiar with unit trust. What is fixed income?
So I think of it this way. Probably say, for example, I have two friends, friend A and friend B. Friend A is working in a civil service job and is asking me for $1,000 as a loan. So, being in a civil service job, unless something really goes wrong, person is able to pay me back because they have a very
So-called iron rice bowl.
stable income coming in. On the other hand, probably another friend is starting a business, friend B, and he's asking me for $1,000 loan. Then that's where I will really think twice, because the chances for succeeding in business, as we all know, probably is very low. So that is why the creditworthiness of this friend B is much lower than the first friend that is probably, for example, in a civil service job. Yeah.
But I believe the trade-off would be that to invest in something with a higher risk, you will be able to reap more returns, right?
Absolutely.
Generally.
So in this case, friend B would need to offer a better interest or a better return overall than friend A.
In order to make it worth my money and time.
That's right.
Absolutely.
Right.
Yeah.
Absolutely.
So since we're talking about investments as well as how to make our money worth its time, right? So Aberdeen is an investment house, right? So we would like to find out a bit more about Aberdeen. So can you elaborate and share with us a bit more about Aberdeen's core investment principles and how Aberdeen caters to the diverse needs of different investors?
Absolutely. Well, we're a global specialist asset manager with around 60 billion US dollars under management. And on the fixed income side that I'm sort of focusing on, we run about 170 billion of US dollars in management of assets. Now, we like to consider ourselves as a specialist asset manager, and these specialist capabilities include Asia and emerging markets as one, specialist equities, so that can be anything from income-focused funds to small and mid-cap funds or thematic funds, real estate or infrastructure, which is also known as real assets. Sustainability is also something we look at within equities, but also private and public credit, which is more the debt side. So that is what we would say is our specialist capabilities. This does allow us to offer clients a diverse range of investment solutions or investment options when they come to us. And then it also allows us to tailor, or at the very least, look at the different client objectives, because every client is different. We talked about friend A and friend B there. Everybody has a different investment objective. So therefore, it's good to have funds or investment solutions across those different capabilities that can cater for those client needs.
Right. You talk about different investments objectives, right? First thought that came into my mind is like, isn't the objective to make money? But I think to go into that a bit, when we talk about different investment objectives, it's because the objective, of course, is to make money. But more beyond that, what purpose will that money serve?
Absolutely. So I think different objectives could be that a client is closer to retirement, so they need income solutions because income is, or maybe they're in retirement, so actually income is something they need. They no longer have a job or a steady salary, so anything that can produce an income is absolutely something would be catered for them. However, if you're just at the beginning of your investment journey, you maybe want to grow your assets, maybe you want to grow your investments to allow you to then put a deposit down on a house in the future or something like that. So every client will have a different need or objective, and being able to offer different funds across a spectrum of investment opportunities allows clients to then be able to pick what they think suits them. And if they aren't able to pick themselves, then they can obviously go to a financial advisor who will then work with an asset manager to help deliver something for them.
Yes. It's like looking at a menu, but the menu is in French. And you start asking the waiter, I'm sorry, what does this soup de jour what is that? But yeah, I think that is in a way the role of a financial advisor, which helps us segue into the next part, because I believe a lot of our friends out there, they would have a lot more experience with financial advisors rather than fund houses. Of course, there are people who are savvy investors in their own rights who might be able to discern. But I think the general man, the man on the street, usually we look at it all and we see a whole list of things. We don't know where to begin. So tell me, Vincent, right? Investors usually face a plethora of fund choices. There's so many, like different asset classes, different fund houses. And what does it all mean? How can a financial advisor assist clients in selecting funds that align with their individual financial goals and risk tolerance?
Wow. That's quite a huge question. But probably let me recount how when I started this particular industry, I faced the same issue as most investors. When you take a look at the fund fact sheet, the fund fact sheet says almost the same thing, especially if it's in fixed income, for example. They'll say that, their objective or their goals is to ensure that the capital is preserved or at least investing in those kind of low-risk assets. And they try to give you a high yield as well. So in that particular situation is where, when I was beginning in this journey, I had a tough time comparing, Fund A and Fund B. Fund A giving probably 5%. Then Fund B is giving 8%. So at first glance, Fund B may look better, right? But it may not always be the case. So let me quote an example whereby, like what Amit mentioned earlier, whereby different funds could apply to different people at different stages. So say, for example, Fundsmith. Some of the investors out there probably may be familiar with this. Fundsmith has a very good track record. They started, I think, if I recall correctly, somewhere around end 2010. So to date, there's about 15 years of track record. Their compounded annual return per year is about 13%. So if let's say probably I just started out, so probably I could be looking at Fundsmith to grow my money, for example. On the other hand, if let's say, for example, I'm already retiring, I'm looking for a safe instrument to invest in, probably I can take a look at Aberdeen Global Dynamic Dividend Fund. That fund is giving at about 6% dividend, and they invest in high quality companies like your Microsoft, Alphabet, and things of that nature. So given that situation, probably if I'm retiring or already a retiree, I could be looking at Aberdeen's fund, for example, to invest. Same equity fund, but the purpose and objective, yes, like what Jackie you mentioned, to grow money, but grow money in different ways. One is more on capital gain from $1 to become a $2. The other one is more of an income stream, which is where our focus is today, for more on the income stream, because during this period of time, it's very volatile.
It is. Every other day you see big things on the news, and there's so much unrest. It really gets people worried, And especially, I think, for people who are later years, they don't have as much of a runway. They need more cash on hand. So in this case, I think Vincent mentioned something about the Aberdeen Global Dynamic Dividend Fund. So could you tell us a bit more about that? Are you familiar?
I mean, being a fixed income investment specialist, not one that I cover, but I do know the fund. It is an income-focused fund or a dividend fund, so it will focus on capturing as much, let's say, dividend opportunity as possible. However, it does use a kind of special dividend capture approach where it does try to analyze when companies are about to issue dividends and then being able to almost capture that dividend but not really have to hold the stock for much longer than required. But the fund itself, as Vincent mentioned, the objective of the fund is very much aimed at clients who want income, who want that dollar in their pocket, as opposed to dollar to grow from 1 to 2, and that is very important for, I would say, people in this environment where yields are falling or fixed deposit rates are falling. So you look at what you're getting in your bank account in terms of cash rates. Since 2022, cash rates have steadily declined. And that has then become a challenge for both clients, investors, and asset managers to decide, how do we then move to the next part? What's the step? How do we take clients from just being able to sit in cash and benefit from very, very high interest rates? That is no longer happening. Now, what is the next stage? But again, you mentioned there's a lot of volatility out there. So you have to think about strategies that don't only offer an attractive objective, whether it's income or growth, but something that also offers diversification. So that's something that clients have to consider as well.
So stability, let's go for fixed income funds.
Absolutely.
Yeah, got to go one big round and say, okay, mine's the best.
Absolutely. Yep.
I think but the truth of the matter, and we all know that there are many different funds. In fact, people do not just buy into put all their money in one fund. I mean, there is the adage of not putting all our eggs in one basket. But I think people who even dip their toes into investing, diversification is the name of the game, isn't it?
Absolutely.
Yeah. In this situation, so I talked about heard a bit about the Global Dynamic Dividend Fund, but I do have one in my notes here, which I need to hear more about it. This is the Aberdeen Indian Bond Fund, which has shown notable performance. Could you highlight what are some of the key benefits and how it fits into a diversified investment portfolio?
Yes, I mean, it's a fund or even a market that many people will not have heard of or be very familiar of. And that is by design, actually. India has only become, in recent times, to go ahead with liberalisation of their bond markets. What does that mean? They're allowing foreign investors to start investing in the debt market. And that actually has some really good benefits when you have a very well-held, say, market domestically, so you're not having inflows and outflows. So the fund itself gives investors, by having a fund, it gives investors access to a very, let's say, traditionally difficult market to get into. You need to have certain licenses and certain access set up, so that isn't easy. You know, that is both asset managers need to do that or individual investors. So our fund does offer that. The fund itself invests in a market that I would say is the second largest market, sovereign market in Asia, ex-Japan. So for a market to be that big and not be known is quite unusual. But that's probably something where, you know, coming to the liberalisation of the market, and what do I mean? I mean index inclusion. So Indian bonds have been in the news quite a lot recently as the bonds have become included in a number of indexes. So indexes are typically these reference benchmarks that funds will follow. So India has started to be added to a number of these. So why is that? Few key reasons. India is an investment grade. So we talked about credit worthiness earlier. So it's an investment grade sovereign. What is that? It means it's got a very good quality or very good credit rating. The market itself has shown amazing diversification. You know, if you look across correlations, which are just the kind of, you know, how much does something move against another asset, you know, Indian bonds show very low correlation. So that means if something goes one way, the Indian bond market tends to not follow it as much, or maybe even goes in the other way, which is good for diversification. If all your assets start moving in the same direction, you don't have diversification. So Indian bonds have that, and that's one of the key aspects of this, I would say, strategy and why it's appealing to investors. Secondly, the currency itself, the Indian rupee, you know, traditionally, I would say people probably have a view that it's a very risky currency. Actually, it's not. It's been one of the lowest volatile currencies of recent times, and that's comparing it against other Asian or other emerging market or even developed market, global developed market currencies, either G7, G10 currencies. These two aspects, the low correlation and that low volatility of the currency, makes it a very appealing asset class, and it's delivered amazing performance. I think if you look at just the market itself, so not our fund, it's delivered close to 60%.
60
over the last 10 years. So that's roughly
over 10 years.
But that's roughly 6% a year from a government bond fund.
Yeah, a government bond fund.
You know, that is high quality.
Yeah.
So for me, that shows you through a very long time horizon, this particular asset class or fund can deliver. So for us, the key aspect is, you know, the diversification benefits from the, as I said, the low correlation and also the low volatility of the rupee. Right now, it's yielding quite attractively, around 7% as well.
7.
So for that, now when you're obviously investing in rupees, you need to consider the potential foreign exchange impact. And I think between Singapore dollars and Indian rupee, there's quite a similar correlation versus the dollar. So they both tend to perform well against the dollar at the same time, and they both they both will underperform. So if you're a Singapore dollar investor going into Indian rupees, really the correlation between the two currencies is quite, I would say, similar versus the dollar. So you don't need to worry so much about your returns.
So in that sense, a investor were to use US dollars, there would be more exchange risk when it comes to investing.
On average, about 2% per annum is typically. However, as I said, the rupees being one of the more, I would say, resilient performers of recent times when you look at Asian currencies and just even global currencies. And again, that comes down to, I guess, a big change in the way the central bank actually manages the currency there. What the central bank did about 13 or so years ago was decide to build up their reserves. So all the cash or assets that they can use to help stabilize the economy or even the currency. And they have probably, one of the largest reserves in the world, maybe at least in the top 10 of all countries. So what that allows the Central Bank of India to do is in times where the currency is depreciating quite quickly, they can step in and deploy a lot of cash to buy rupees and steady that currency. So you actually have a central bank who can do that. Typically, emerging market economies can't do that because they don't have the reserves.
Right.
That's why you can get a lot of volatility in a currency because they can't intervene. They have to allow the market just to take the market forces to play out.
Yeah, it seems like you've done a lot of homework with regards to India. I mean, I think it is a market to look out for. But how about from the financial advisor's standpoint? What are your thoughts on the Indian market?
Yep. Probably let me jump in a little bit more on foreign exchange risks that Singapore investors may face. The good thing is, thankfully, we have professional people like Amit, so we don't have to worry so much. We can leave the heavy lifting to him. And the good news is for such funds, generally, there will be this share class, which is called Singapore Dollar Hedge. What it means is that if, let's say, I'm a Singapore investor, I don't have to consider about exchanging it to become a USD or rupees to invest in that particular fund. I can continue to invest in Sing dollars, and that is where they will do the hedging for me and prevent such kind of huge market fluctuation. Yep. So I'll leave the heavy lifting to the professional. On a side note, Amit, I have a question for you. India, I would say, like what you mentioned earlier, is not exactly the top of the mind for most people. And I did some homework as well, and I realized that for India right now, in terms of growth, is slowing down. Based on my research, I saw that IMF is saying that it's slowing down from 6.5 to 6.2%. And in terms of the private investments, it's not exactly the strongest at this point in time. There are a lot of unpredictable tax regimes. So how does professionals like yourself manage this kind of risks in the market?
Yeah, no, absolutely. These are things that we have to consider when investing in the Indian market. However, the great thing is at Aberdeen, we do have our professionals that will go there and they will speak to the policymakers. So they will go to India. They will actually meet all the policymakers, all the key decision makers and understand what's going on. And that gives us that kind of really good on the ground understanding when it comes to whether it's tax regimes, when it comes to private investment or investment into India. What we can say is that the future looks bright for India. Yes, some of those growth numbers are slightly lower than expected, but I think India is going to become a huge beneficiary of what we've seen recently in terms of the trade and tariff situation that has come about. You've actually seen quite a lot of production now looking to be shifted towards India, supply chain production to India through a more favourable tariff arrangement. So you'll have seen a number of countries, including India, rush to the White House not long ago and trying to do these deals with the US. So India is definitely open for business. iPhone manufacturing is pretty much, being done out of India as well. So I think there's a lot of positives that India has in terms of growth. Yes, it's slightly lower than expected, but India has definitely got the kind of key dynamics that actually is probably a general theme of Asia in general, where there's kind of growing wealth of whether it's middle class wealth or just general wealth creation in some of the economies around the region. That is definitely going to be an important driver of domestic growth and also attracting foreign investment, whether it's, companies setting up But I would say for us, having on the ground knowledge, being able to input into those discussions very much helps us make an informed decision when it comes to investing in markets like India.
There's really a lot of insight. I think people listening in, it's not just insights on investment, but quite a bit on geopolitics as well.
Absolutely.
Yes.
Yeah, thank you for sharing that. I can call you a professor.
That's why he's the specialist.
Indeed. Very evidently so. Yeah. But of course, right over here, we also want to find out a bit more about some other funds. Since that we have a specialist here, let's milk it.
Absolutely.
Right. So with interest rates coming down, what are some alternatives to low-risk investors that can consider in terms of diversifying their portfolios?
Yeah, I mean, I know, and Vincent will know this. This is kind of one of the key things I was talking about since 2022, when interest rates were very high. I mean, I'll even admit it myself. We all became a bit lazy in terms of investing, right? We all just thought, leave our money in the fixed deposit, leave it in cash. You know, we all got a bit lazy. And actually, that's now something, a bit of a challenge for us all now. You know, yes, people who are savvy, as you mentioned earlier, the more savvy or comfortable investors will have already started to look at options to move out of cash. But for those clients who are maybe, as you said, actually retirement, maybe don't have as long a runway, or those who have income requirements, it's not so easy to just lift yourself out of cash and go into something that might work for you. So an option that we have at Aberdeen is our short-dated enhanced income fund. Now, really, why did we design this product? We launched it in July 2023, so that's a year after I moved to Singapore, just to make sure we get the dates right.
So you're one of those that spearheaded the fund.
Were you one of the persons who spearheaded it?
I mean, as actually, to be fair, as a investment specialist, we are part of the product strategy discussion, right? Alongside our sales colleagues, our partners we work with as well. We'll work with some close partners. So absolutely, we have to get feedback from clients, from fund managers, from our sales teams, and the specialists. We all need to kind of input to ensure we don't miss a trick, and we make sure we hit the mark. So I think with this fund, the short-dated enhanced income fund, I think we really hit the mark with this one. So what you'll have noticed is that in 2022, interest rates went up very quickly. And what that meant was you had this anomaly where if you invested for a short period of time, you actually were getting a higher interest rate than if you locked your money away for a longer period of time. Yeah. So that was because there was a huge rise in interest rates globally to fight inflation. That was the key reason. So what you saw was short-term interest rates move higher, and actually longer-term interest rates didn't really follow, because that's not the driver of those parts of the interest rate, let's say, curve. So really for us, that was a great opportunity to say, look, we can provide clients with almost a cash replacement strategy that is of high quality. We talked about this earlier in terms of credit quality or credit worthiness, something that is high quality, but giving you a higher interest as well, or a higher yield. So that this short-dated enhanced income fund does that. We based it on 3 guiding principles. I think if you want to be a cash replacement strategy, you really need to demonstrate what that means. And I guess for us, one of them is you have to yield better than cash, right? You know, if you're going to encourage people to come out of cash, there's got to be a reason. There's got to be a benefit, right? So first thing is you've got to do that. So by the way we do that is we have a huge investment platform that the fund managers who manage this portfolio, they will essentially leverage the best ideas from that. And I guess that's across both, you know, developed markets, emerging markets, Asia. You know, it can be government bonds, it can be corporate bonds. So that's debt issued by governments or debt issued by companies. So there's a big universe there available. So that's to help with the yield aspect, or the return aspect, or income aspect. The next part is price stability, because really that's what cash gives you, right? Cash gives you price stability. So for us to make a credible product that could come out and really give people the encouragement that this will try to behave close to something like cash. It's not going to be cash, but something cash. What we did was put two kind of very key, let's say, guidelines in place. One of those was having an average credit quality or credit worthiness. We talked about friend A and friend B before. So what we've done is put a minimum of A-, which is quite high up. It means it's very, very kind of good quality overall. So the average quality of the portfolio needs to be quite high. And then you also have something which is interest rate risk. So there's the risk of, bond prices moving because interest rates move. So we've tried to keep that low as well. That's called duration, but I won't get into the technicalities of that. But essentially, we've kept that low as well. By keeping both what we call credit risk, which is the credit quality, and the interest rate risk low, that gives us good price stability. We'll then apply some guidelines around sector limits and exposure limits to ensure we're not overly exposed to any one sector or asset class. And then finally, the third one is liquidity, right? I mean, if you've got cash, you want to be able to access it, right? So if you've got a cash flow placement strategy, you want to make sure you have liquidity. So we'll always ensure there's a huge portion of the fund, or not huge, a significant portion of the fund in both cash and government bonds. And that's to ensure that when clients want to access cash in this fund, we can deliver it quickly to them. But similarly, if we are able to deploy cash into some good opportunities, we can do that very quickly as well. So having a very good liquidity, let's say, characteristic is also something. And then finally, that was the three kind of principles, but we also wanted to target drawdown being low, which means we don't want the fund to be volatile. And that is something that we target as well. So as a cash replacement strategy, is something that clients or customers or even ourselves want to move out of cash. This is very credible. It will look to give you that outcome that is better than cash, but not necessarily going to sort of follow the lower interest rate or trajectory that cash is seen. It's a global fund as well. So as I said, it's able to access the best ideas, whereas here in Singapore, we really have the banks you bank with or or mass bills, which have been obviously falling quite markedly as well.
Yeah,
Indeed.
Yeah, so
Seems to be the trend.
Yep. Yeah. In the event if it's too much at this point in time, the conclusion is short-dated enhanced income fund is a safe fund. The duration is, as the name suggested, is short, so therefore it will not fluctuate in terms of price as much when interest rates move. And more importantly, understand that they are giving about 5 to 6% coupon at this point in time.
So it's just around about 5.5% yield. So we have to be clear here. Yield means not only the coupon or the interest we receive from the bonds, but also when we talked about similar to mass bills, where the bond is priced below the value it will mature at, then you get that capital appreciation. So yield is a component of capital appreciation and the income. So at the moment, it's about 5.5%, and that's in dollar terms. So even if you were to hedge that back to Singapore dollar terms, you're talking about 3.5 or plus upwards of 3.5%, which when you look at cash rates right now or deposit rates, I don't think you're getting anywhere near that.
No, I think the most recent one I saw from Fixed D at one of the foreign bank was giving about slightly north of 2.
Yeah.
So
even the high yield interest accounts, they've also dropped their interest rates now. That's right. Below 3%. Yeah. So, but I think this is a demonstration of how the financial advisor comes in, because we do have a specialist. I think, and from this sharing, it's very clear that it is something that you worked very hard on. you went into so much detail about it. Yeah. And then, of course, sometimes for the layman will look at, what does it mean?
That's why
Vincent comes in.
I'll get the inputs from them and then I'll summarize it and package it.
Absolutely. Yeah. No, that's why we have to work hand in hand with our advisor partners.
That's right.
Your job is to create the best product, and his job is to let customers know that that's the best product.
Absolutely.
Yeah.
Absolutely.
That's how the synergy works together. Right over here. How about, let's say if investors are looking for income, but want to reduce their exposures to areas like the US, what are some abrdn funds that investors can look into?
I'll try and not be as specific on this one. I'm going to try and keep it as
No
high
worries, no
level.
worries.
Let me see. Let me see if I can do this. Well, we have this fund we launched here in Singapore earlier this year. It has a longer track record, about over 10 years, but we just launched it in the Singapore market earlier this year. It's called the Global Income Bond Fund. And this fund, essentially, it's looking to give you high yield like returns or outcomes, but with investment grade risk. So what we're trying to say to you is we're trying to give you the best yield we can give you, but make sure the credit quality, the credit worthiness is very strong. So the way we do that is the secret sauce is a part of the market that provides what we call the best risk adjusted returns. And that is a part of the market where bonds are rated BBB, which is the lowest level of investment grade or the lowest level of the kind of good quality, you could say, debt, and BB, which is the highest rating of what we call high yield debt. So ultimately, there's a lot of mispricing in that part of the market, if you want to say, and having investors or a global research platform that we do allows us to unearth some of the really good ideas there. So things that are we would call rising stars. So those companies who are doing really well and will eventually become very high quality companies going forward, or those that have maybe gone through hard times and are a turnaround story, but it might be, maybe 2 or 3 year story. So there's things that we can do and unearth really good opportunities there for clients. So it's part of the market that's delivered exceptionally good returns. So if you look at a high yield index, so kind of very, very kind of risky index in the bond space, it's probably this part of the market we're focusing on for this fund is probably kept up with that, like in terms of returns. Let's say over the last 25 years, probably 6.5 to 6.7%, let's say, in terms of annualized returns over the last 25 years. So it's very close to global high yield. So 6.2 versus say 6.5. The volatility though is more closer to your better quality bonds. So the inherent sort of, let's say, risk of a, say your two friends, friend A and friend B, was it friend B who started the business? The inherent risk of friend B going out of business, in which we would call defaulting on their obligation. So the risk of that is very low because this part of the market is demonstrated to be, where you can identify the best risk adjusted returns. So for clients looking at income, it's roughly just around 7% yielding at the moment in terms of the income. And to get away and diversify, it's a key phrase we've been using today. Vincent used it a few times as well, was a lot of funds and a lot of portfolios and a lot of clients may have exposure to the US. And actually what this fund does is it actually limits its exposure to the US. It has about 30% in the US and the rest of the fund is mainly in developed markets with around 10% in emerging markets. So very well diversified geographically. And then from a sector perspective, it's diversified across 13 different sectors, and then no sector is greater than say 10 or 12%. So nothing overly dominates. But when Vincent's looked at a lot of fact sheets for a lot of funds, I'm pretty sure. So and he'll have seen some other options out there in the marketplace that have 70, 80% to the US, and then maybe 60, 70% or around that in particular parts of the US market. So these are things that clients, by looking at a fact sheet, it can be useful, but obviously going to someone like Vincent who can help and just add a bit more color can make sure that, yes, these are probably good options, but if you have something like the Global Income Bond Fund alongside that, or as another alternative, it's definitely something to consider, particularly in this environment where we've seen the US causing a lot of volatility generally in the market.
Yeah.
Oh.
If you don't mind me jumping in, is that most of the global funds out there generally have about 50 to 60% exposure into the US or probably in the developed markets. So I think where Global Income Fund from Aberdeen comes in is that they have a lot more diversifications into other areas like, say, for example, Oman, Peru, or even Kazakhstan. Yeah. So given some of these countries, it seems like as a lay person, it doesn't quite strike me as very confident or inspiring kind of countries. So what's the take from the specialist point of view?
Yeah, I mean, as I said, we, at the moment in the fund, there's about 10% in emerging markets, but luckily, you know, for everyone and everyone listening is that we have a huge team of fixed income professionals, around 140 of us, or over 140. And some of those professionals focus on these markets and they have to understand those markets very, very well. We have actually people who physically will, let's say, go and visit these markets and will do their on the ground research. So for us, it's about selecting the best ideas. And yes, they may be, you know, fairly unusual sounding investment exposures in a fund. Actually, that's where Aberdeen can provide some value add and differentiate itself, because having that resource or capability to go and do the research in these smaller, less researched parts of the market or countries, that's absolutely one facet of where we can deliver returns and alpha for clients. But for this fund, Global Income Bond, emerging markets is a smaller portion. And yes, those will be, you know, weighted accordingly to the risk they present in the portfolio. But the bulk of it will be in that sweet spot I was talking about earlier.
I think what I really like about the fund is that we have specialists like Amit to do the research, because some of these countries probably they are often overlooked. And as a result from there, we get outsized returns when it comes down to your conventional funds out in the market.
Outsized return. Can you expand on that? What outsized returns are?
Okay, so probably let me go back to the concept where Amit mentioned earlier about risk-adjusted return. So say, for example, in this case, the Global Income Fund, if I recall correctly, was about 6% of interests that the investor will be getting. And then the annualized return, which is probably the average return taking into account the time average, is about 6.5 for high yield. So for the context of those who are totally new, high yield you're investing in, like, for example, a lot of friend B, a lot of businesses that probably are just starting out. They give you very high returns, like maybe about 8 to 9% in terms of the interest or the coupon that you received. But the fluctuations that as an investor you have to bear with is maybe about equity-like kind of a fluctuation. So if the equities drop by maybe 20%, like back in the April, as of now, the recording is in June, right? April, the drop was maybe about 15 to 20% for the US stock market. Yep. So imagine for this kind of high yield, you're dropping maybe about 10 to 15% in exchange for that additional 1 to 2%. So if I'm an investor, right, I think it makes more sense for me to invest in something that's 6% of interest coming in, but my fluctuation may be about somewhere around 5% or less than that. Yeah. So given that particular situation, 5% fluctuation, but I get 6% of returns.
Rather than 20% on 6.5. 20% fluctuation on 6.5.
That's right. Yeah. So that's to me in a way where, because of their specialty and more importantly, I think their foot on the ground. So that's the part whereby of course, some investors may be thinking, wow, Vincent, if I were to go to fund houses like Aberdeen, I need to pay a lot of money because they need. But the thing is, I would say let's not be penny wise and pound foolish. If let's say we can get this kind of very good returns with, I would say, stable kind of fluctuations, then that kind of fee is worthwhile, is because I do not need to go for high yield, because as probably if I'm retiring or as a retiree, I want to go for something that is stable, that can give me regular, predictable interest or income coming in, rather than something that, today I can get $100, tomorrow I get $80, then the next day I get $120. So that kind may not be able to help me to plan my retirement lifestyle accordingly. I do not want to be subjected to say, okay, today I get to go to a restaurant. Tomorrow, because the market dropped, I need to go to a coffee shop and drink a 80 cent. I think 80 cents also not quite possible.
Times have changed, bro.
Probably a 120 or 150 kopi O kind of situation. So given that, I think it's important. It comes back to the objectives, like what we mentioned earlier. What's the kind of lifestyle that we want, and how this fund can actually fit in.
Right. I think that is something that you as a financial advisor, one thing that you are usually doing, because like I myself, I look at these so many different sort of funds, and sometimes the global income fund, I don't even remember the names of the funds, and they seem to be doing the same. They seem to be yielding the same results. So what does it all mean? So right over here, I think this is where we want to hear a bit more from you, right? So because Aberdeen's are one of the funds that you guys are, one of the funds that you guys carries, well, how can these funds be effectively integrated into your customized investment strategies? What do you look at?
Yeah, I think from my perspective, I'll think of it this way. As an advisor, we will go to clients, and the usual process is we will do a fact finding of our understanding what's the client's situation, what's their current unique concerns that they have, or probably challenges, and then from there we'll tackle it. But at its core, you can think of it this way. It's just like you going to a restaurant, right? So generally, you already know roughly what you want to eat. But if you're new to a restaurant, what do? Would you just look at the menu and then decide, oh, okay, this is the most popular dish and therefore I just order this dish?
It usually is the case.
Yes, that's right.
And then the dish comes and we regret.
Yes. So what is popular may not be fitting to your taste buds,
Yes.
right? So I think that's where probably the waiter or the manager will come in very nicely, whereby they will share with you, oh, okay, if let's say that's the case, hey, Jackie, today would you like to have something that's spicy? Oh, by the way, do you know that we just freshly flown in some fishes? Are you sensitive to probably seafood or things like that? So that's where you notice for probably restaurants that have waiters or probably managers of this kind of caliber, you ask more questions and you realize that the food that you ordered is very suitable, and you tend to leave with a happy meal, so to speak, right?
Yeah. Happy meal.
Correct. So that's the part whereby for us, we are trying to create and customize the set meal for our clients. So say, for example, today, you can, of course, take some of the ideas that Amit has shared today and just run off with it. But the next question is, how much of this particular fund in terms of percentage should I be putting in? Should I be putting 100% in fixed income? Or should I be putting probably 80% in this funds and then maybe another 20% in other funds, for example? So that's the part where financial advisors come in to tailor and customize according to the client's needs so that it becomes easier for them. Yeah, I would say one classic example, if you don't mind me to sidetrack a little,
Sure.
is more on probably changing the portfolio dynamics together with the market as well as the client situation. So say, for example, Amit just got married recently as well.
Congratulations.
So probably the next, I would say, milestone we'll be looking is having a kid.
That's
No pressure.
read my mind.
None at all.
Yeah. So probably if let's say he's planning for his kids' education and investing is one of the tools that he's looking at, so maybe he could be a mix of having equities and fixed income in the portfolio. But imagine if let's say the kid is preparing to go to university in the next 1 to 2 years, then I don't think Amit wants to still have equities position inside there. Probably it could be 100% in fixed income, where the fluctuations of it is lesser. Imagine if let's say I'm the son, then I come to Amit and say that, hey, Daddy, I'm about to go to school next year. Then Amit has to tell me, hey, sorry, son.
It's not a good time.
Let's wait 1 or 2 more years before you go to school. I don't think it quite worked that way.
Right.
Yeah, that's right. So I think that's part where the financial advisors come in. We'll see what's the market right now. Is it very volatile? What's the client's risk appetite? And we'll customize the portfolio accordingly.
I think because with the experience as well as the time you guys spend on looking at the markets as well as different types of fits, you will be able to identify what are sort of the effects of making such decisions. And of course, taking into account the client's lifestyle, what they prioritize.
Yes.
I think this is something. So this is the main role of the financial advisor. How else do you think you can value add?
Yeah, of course. I think the other one is you can think of us like a co-pilot or co-driver of this entire journey. Why I say that is because I think the last one we also mentioned something similar. Back then, in the previous podcast, we talked about Peter Lynch, one of the legendary investor, right? If I recall correctly, his funds return per annum was about 20-ish% for close to about 2 decades or so. But the average return of an investor for that fund was much less than that, probably around less than 10%, if I recall correctly. So given that particular situation is where we as the co-driver or co-pilot of this entire investment journey is to calm the nerves of the investors and let them know that, hey, don't worry, things like this will change because it will not forever be in a down market. Whenever where the market is always in cycles, because that's the part whereby it will actually, if it's down right now, it's a good time to do a top up. But most people, they only know the theory. When you ask them to really put in the money, especially during the April period,
emotions come into play. It's,
yes, exactly.
Yeah, it's what leads people to make, the term brash decisions.
Yes, that's right.
So how do you deal with that?
Correct. I will akin it to probably gardening in a way. Because as humans, we tend to like to see profits, right? We don't like to see anything red in our portfolio, even though red could be a very good time to invest. So the thing is, for us, we come in and we'll advise the clients accordingly, be their sounding board and let them know that, hey, at the end of the day, this is a good time to continue to invest if you have the surplus. If not, let's ride it out and continue your journey. But I do come across certain segments of the clientele whereby, they are still very jittery and they want to sell. And that's my part to come in to calm the nerves and let them know that, hey, this is the data. Do you believe that if you invest right now, given the track record, they'll continue to do well? If they agree, then by all means. If not, then they could be in a situation whereby they are selling their winners and continue to keep the losers. And that comes into a situation like what I'm mentioning about the gardening earlier. You plug out the flowers and then you continue to let the weeds to grow. And after a while, you realize that your garden is not a garden anymore. It becomes like a jungle.
Right.
Yeah. So our role as so-called quote-unquote gardener is to continue to let the flowers to grow and blood out the weeds. And that's where the constant review and the checking in with the clients becomes very important.
Right. So you got to work hard on that front, man.
Oh, definitely.
But I think one of the things, when talking about our client side, I think another thing that they might be more concerned about will be fees and charges. On this part, we do also, since we have someone from Aberdeen, we'll be able to hear directly from the horse's mouth. What are these fees and charges? And they are eating into our profits. So why?
Fees and charges is definitely it's a hot topic, and actually, just for context, the asset management industry, I think actually the financial services industry has probably come under a lot of pressure and scrutiny in the last number of years, whether that's been driven by the client or regulation or just generally the environment. And actually, there is a lot of pressure on asset managers and service providers to be competitive when it comes to fees. Now, we said earlier, if the product's good, then absolutely clients should be happy that they're getting the outcome they need. But absolutely, you want to ensure that you're giving the client or your partner the best, fee arrangement. But really, why do we offer fees for some of our funds? Well, I guess we talked about this earlier, and probably the Indian bond fund's a great example of it, is there's just markets clients can't get access to directly. Now, whether that's because they're unusual markets or whether it's markets that they just don't have the access to, like the Indian bond market. But similarly, there's markets whereby you need to have a lot of capital to actually invest. So if you want to invest in a bond, for example, typically you would need to have something around, in some cases, 250,000 Singapore dollars to do that. Yes, you can go and invest in a mass T-bill or mass bills, etc., Singapore government securities. But if you want to invest in, say, a corporate bond issuance, it's maybe not as simple. And then again, you're exposed to one bond, right? And you need to make sure you've done the analysis of that company, make sure you're comfortable. So I think, that's one area where funds and asset managers can offer market access and diversification within the pool of assets that you're accessing. And again, coming to that point about professional management, having, in Aberdeen, we talked about 600 in total, investment professionals. Within fixed income, 140 investment professionals. A lot of these people are there focusing very much every day, focusing on markets or particular sectors and really looking to get those ideas that will go into the portfolio. That's just not something, anyone can do on their own, So I think having the, fund management house who can do that. That's also another reason that we'll have to look at fees as well. And again, producing an outcome-focused product or a product that is aligned to an objective for that client, or very much a pool of clients or a segment of clients where it's income or where it's growth, that's also something we can do. And I think it's probably a little bit harder for clients to sit and try to make those portfolios themselves. And then at the same time, and Vincent alluded to this, is trying to then manage that on an ongoing basis. So that's where I guess asset managers can step in. And yes, we have to be competitive. We understand that. We've got our own competitors, but we also understand that, clients, as you absolutely said, was, it eats into the return. So we need to make sure that when we are talking about yield or income or growth, if we talk on a net basis, so after fees have taken out, that means it can be more transparent to the client and what they're going to get. So that is definitely, the world has certainly moved more to people being aware of the fees that are being charged. And therefore, as asset managers or advisors, we need to be cognizant that can be part of the decision making. I don't know if Vincent, you want to chime in on fees on your side.
Oh yeah, sure. I say it this way, with regards to fees, I'm glad that the market is evolving and getting more and more savvy. I'll say most investors, they are very focused on just that one thing, which is returns.
Yes.
Right?
And that's the name of the game, man. That's why I put my money in. I want to take more out.
But as we saw earlier from the example of the Peter Lynch fund, you get 20+% return, the track record performance before the fees. But yet the average return of an investor was only about less than 10%, around 7 or 8 if I recall correctly. So given that situation, what was the missing link, if you noticed? Fund underlying actually was doing very well, double digit.
Yeah.
But an average investor was maybe about 7 or 8%. That's a huge gap. There's no way an advisor can charge a 12% or a fund manager will charge a double digit, right? So what was the missing link? If you were to ask me, I think the missing link actually comes back down to the emotions of the investor that we alluded to earlier. So given that situation, you're paying a fee to the advisor. One is, of course, to get access to people like Amit. I wish that if I'm a retail investor, I can just write into Amit and ask, hey, Amit, what do you think of this? But his time is limited. So is everyone else. We only have 24 hours. And Amit, we have to choose what are some of the questions that you have to answer as well. So that's the part where when you engage an advisor who is proficient in this area, you'll be able to have access to Amit, ask the questions that you would like to ask, that if you do go to any other platforms, I think it's going to be quite challenging if you ask me, especially if an investor is DIY. And the other one is with regards to costs in terms of the intangible, like we talked about in the previous podcast. There's tangible ones, which is how much fees you're paying to professionals like Amit or probably to advisors like myself. There's also the intangible. What about the research that you do? I think most times as an average investor, we just, maybe because it's very easy nowadays, we go online, we just buy a click, and then you don't need a lot of capital. Just maybe start off with a few $100s per month, or probably start off with a bigger capital if you have. You don't need at least like 250,000 to invest in this kind of unit trusts. Therefore, in that particular situation, you realize that it becomes very easy to buy. It's also very easy to sell when the investor do not know what's happening. Because like what you see from this podcast, Amit is really very in-depth and knowledgeable about his domain and expertise. But if I'm not exactly sure, probably this particular fund is not even on my radar. And I'll just be going with the flow with some of the bigger names or the more familiar names. So in that particular situation, if I want to get better than average return, how do I do that? It's not possible. So that's where as advisors, we come in, we do our due diligence, we compare abrdn's funds with the peers in the market. What are their strong suits? How can we package this into a client's existing portfolio or make some changes to the portfolio? So that's the part for the fees, so-called quote-unquote justification. But the intangible part is something that people often overlook as well, because I've done my research as well. I realized that especially in the fixed income space, when it comes down to another vehicle, which is what they call the exchange traded funds, meaning that instead of having a fund manager like Amit to do it, they just follow the index, which is the benchmark, like what Amit referred to. But because as a retail investor, I can't invest in the benchmark. I have to go through this vehicle called the exchange traded fund that will track this index performance. So if the index goes up, the ETFs also goes up. The index comes down, the ETF also comes down. So these ETFs, as I've seen across most of the markets out there, a lot of the unit trusts, especially like abrdn, is able to outperform the ETFs. and they give you better returns. So surprisingly, like in terms of what we mentioned earlier about the risk-adjusted return, Aberdeen is paying about 6% in terms of coupons or the interest that it's giving me. Most of these ETFs, if they follow the general market, maybe they're paying about 3 to 4, 5 at best. So you're getting that additional 1%, right? Not only that, in terms of the fluctuation, because these are for retail markets, right? So imagine if I suddenly see, wow, Donald Trump keeps hounding that we want to cut interest rate, but nobody is cutting. And then suddenly the market actually drop for this kind of indexes. So given that situation, I get a lot more jittery. The fluctuations is more, right? As compared to over on the Aberdeen side, probably they work a lot with advisors and advisors can give sound advice. That is the part whereby the fluctuation for this is much lower. So imagine you get better returns by about 1 to 1.5, but at the same time, the fluctuation is lower compared to your normal ETFs. So wouldn't that be an ideal situation where you should be happy paying some fees? Yeah.
I mean, there's never an ideal situation where I'm paying fees, but we all can live in la la land and not pay fees. But I think the fact of the matter is that there are people who are spending time on this, and it's just like when we go to work, we expect to be paid for our time, and as well as all the things that we do behind the scenes. We do hope that our boss pays us for it. And I think we have to put ourselves in the other party's shoes. So like what you have mentioned earlier, we heard so much from Amit, very in-depth, even knowing about how things are going on the ground, what the government is aiming for, what the government has plans for. And all these don't just download in our head automatically. There's research that goes into it, right? I'm sure Amit has spent so much time, and let's just drop him a buck or two. There's probably a lot of work, especially like one situation you brought up earlier, because of all the volatility and on the US policies. I believe it's a headache, and I think on the side of Aberdeen, you guys are probably scrambling a lot.
Oh, man. I think,
look at the expression. It tells me a whole story.
I think when the tariff situation started, we probably had a new slide every day. Just things kept changing, Even penguins got a 10% tariff. That was one of these islands which only has penguins on it. Even that was subject to a 10% tariff. But I mean, yeah, absolutely. Right now there's wars going on. There's the tariff situation going on. In fact, it's just incredible to think that all these things are going on in the world. And, we just have to kind of get on with the job. But certainly Aberdeen, we have enough people who are either looking at the markets or these particular situations and then analysing it. So we actually have a global macro research function. So these are kind of economists, a team of economists. And essentially they will look at these scenarios and try to identify what they think are the potential outcomes. What will happen? Will outcome A happen, B or C? They try to attach some probability to that. So the tariff situation is a very good example, actually. Our global macro research team came out with, what they thought could be the potential outcomes of when Donald Trump had come into power, because he'd already made some noises about tariffs and implementing these. So our global macro research team had come out with one scenario. I think it was called, I can't remember the name, maybe Trump Unleashed or something like that. But essentially the average tariff that they had calculated, they thought the average tariff to be employed would be around 20%. And actually, right at the beginning of the whole saga, I think the average US tariff was around 23. So actually weren't that far off, in terms of our analysis. But it's the fact that they knew that there was going to be some form of implementation of a tariff, and that then what is the fallout of that? So really the heart of what we do at Aberdeen as a fundamental active manager, and pretty much more or less all our strategies, is we need to ensure that we manage volatility by not only looking at the markets, having resource on the ground, various touch points, but we are then listening to broader views from our macro research function, who can then give us what they see and what they're hearing as well. So for us, having all of that information, having the research done on the ground, having the global macro research team able to analyze geopolitics, analyze data coming out, whether it's growth data, inflation data, whatever data is coming out, that becomes really helpful. It's then upon our investors, our investment managers, to take that information, use what they know about the markets they're investing in, and try to apply that in a way that helps not only unearth very good opportunities, but also manage volatility in portfolios. So whether that's a good example actually would be the Global Income Bond Fund that we were talking about earlier. That fund, in coming into just ahead of the tariff situation and induced volatility in the market, we actually had quite a bit of that fund in cash and government debt, sort of high quality government debt, and just cash, probably around, I think it was probably around 15% in total across both. And actually that was the right move. We just felt there's this uncertainty coming towards us that we're not really sure how this is going to play out. So why not just take a little bit of risk off the table? Let's keep a little bit of a buffer here for ourselves to be able to either redeploy when the market sort of settles down, or as you said, in some cases, add to those positions that you have high conviction in or very favored positions. So that's kind of what we did. We actually went into that with a little bit of caution, and that really served the portfolio very well. So things like that and taking everything into consideration, that's how we look at, it's not just what we call top down, so looking at the top down with our global macro research kind of, or the kind of broader picture views, but the bottom up as well. So really understanding the markets or the companies that you're investing, but marrying those two together really then does give you that advantage when it comes to both opportunity and managing volatility.
I think there's a lot to take in. I mean, I have been saying this, but this is a testament. Like what we have been saying, this is a specialist job. And clearly there has been a lot of research, a lot of work, a lot of thoughts, as well as a lot of theory forming that goes into it. So such that when things happen, we are able to remedy it quickly, or at least approach it, adjust the course very swiftly. And when things move quickly in the world, we have to move even quicker. And that's why we pay you the big bucks.
That's right. Believe me, the emails don't stop.
Can imagine.
Yeah. How about on the Vincent, on your side, as you're closer to the clients, what would you tell people about managing volatility?
Okay, that's a good question. So maybe I'll use a situation where I came across more recently. This particular client has been investing in Asia for quite a while. So for those of you who are familiar with the market, you know that Asia market is generally dominated by either China and India. And during the earlier years, China market hasn't been moving anywhere. In fact, they have dropped quite a bit. Yeah, so that's the part where on this particular situation, I have two types of clients. The first type of client who actually have more confidence and conviction, but maybe they are not so interested in Asia at this point in time. They want to continue to dollar cost average. So we moved into something safer like a global fund that is in equity space and probably a bit more on the equity fixed income side as well. So the other investor did not continue to dollar cost average because you're jittery. I want to wait for my capital to break even first before I do anything more.
That's not the way, man. So when it dips, you buy it.
In theory, yes.
In theory, of course.
Yes. But in reality, the actual execution is so difficult. So moving forward, we saw that Asia, I think at this point in time, has rebounded quite a bit. So guess among these two investors, was it the first investor that did well or was it the second investor?
Okay. I think the first one, of course, right? The one who stayed the path.
Correct. That's right. So that comes back down to the question of as an investor or probably advisor, how can we encourage clients to continue to invest or remove that so-called quote-unquote volatility is by dollar cost averaging. So in simple terms is every month I continue to park a certain amount of money into that investments. The regions or the selections or the underlying can change, but the act of putting in the money and parking it every month is very important because market goes up, market comes down. And even if markets stay down for a period of time, I think at this point in time, China has been down for 4 consecutive years, if I recall correctly. Yeah, so potentially when it rebounds based on historical records, they can go up by at least 50%, for example. So that is the part where for those people who are more courageous and continue to park their money and invest, you'll be able to get the upside.
But to continually put money in for 4 years as it's going down, it must take quite a bit of a mental toll, right?
Yes. So that's where the experts come in. Because I think from my perspective is, I like to ask a very simple question. Imagine if stock A, say for example, DBS, dropped by 50%. Stock B maybe is an unheard of company, maybe company...
ABC Trading.
Yeah, ABC Trading. So given this particular situation, which one will you have more confidence in parking your money in? I think it's pretty obvious, right? DBS, right? Then you'll be like, hey, both dropped 50%. But why do you have more confidence in DBS? Then we go back down to the fundamentals and you realize that because you have a lot of context about this DBS. For example, is a government bank. Singapore government would not allow the company to collapse. Because if it does, I think we're in quite a trouble. As compared to probably ABC Trading, for example, you got zero clue, zero idea. I think so that's the part whereby professionals like Amit come in and they'll be able to give us as advisors context, because as advisors, we don't even know everything about the market. We also rely on them for the inputs. So that's the part whereby we get information from them, we digest, we see how can we relay this information to the client in as simple way as possible. So that in that particular situation, if clients continue to park the money there and continue to invest on a monthly basis, that's the part whereby they can see their money grow, rather than is ad hoc basis kind of situation, and then you see that your results become very random as well, very ad hoc as well. Yeah.
As a sort of a guide to keep you on the course, right?
Yes, that's right.
I think sometimes in the fog we lose track of the North Star.
That's right.
And then, at least you have someone to remind us, keep looking up, keep staying the path. Because we charted out this path. This path is going to take us to our destination. Well, thank you for all those, Vincent. So right here, we're coming to the close of conversation over here today. I go on to a light-hearted segment or a brief segment. To wrap up our conversation, what are some key takeaways that you hope that our listeners over here would consider and remember in their investment strategies? How about we start with you, Amit?
I think for me, the key advice I would give, or key takeaway, would be diversification.
Diversification.
Look at your current portfolio or investments, and where appropriate, diversify, whether that's into global strategies or into strategies that you might not have heard of, but offer very good diversification. Also, reassess your objectives of what you want to achieve, because the markets have moved quite a lot since 2022. Like I said, we were all fairly lazy investors back then, just parking away in fixed deposits for as long as we could at the highest rate. Yeah. So I think now is the time to look at, is it time to step out of cash, and how do you do that? Is there a strategy or an option available, which we've obviously discussed today? But similarly, if you've already made that step, is your next step aligned to an income goal or a growth goal? And then maybe that's the next stage. So I guess it's about diversification and then kind of reassessing, because yes, the market is changing. The landscape has moved, particularly here in Singapore. I would say the landscape has changed quite a lot in terms of, what the options are available now. And for clients, I would say that's probably the key things I would say.
How about you, Vincent?
I'll just sum it up and look for a professional.
Remember to pay them.
Yeah. Okay, so I think throughout this entire podcast, most audiences would agree that, Amit here is very professional. He knows his stuff. So imagine if he's just an email away or phone call away. Anything that I'm not sure, I can always check in with him in terms of what should I do with the market, given this current market situation and such. So I would say looking for a professional will actually be very helpful if, let's say, you don't know where to start. How to adjust the portfolio, or at this point in time you have a lot of weeds in your garden. How do you pluck it out and plant more flowers, for example? So that could be one way. Or if, let's say, for example, at this point in time you want to start and then you want to look for something that is safe instrument, you don't want to take on the volatility, you just want to get your feet wet first to try it out, then probably something like a fixed income strategy would be very useful. Yeah, but of course, if you are ready for something more adventurous, then we can discuss further.
Right. I think to summarize, I'm talking about diversification, yes, and always to regularly reassess our goals, make sure that we are making the right decisions as our life and the environment changes. Yep. And of course, Vincent, talking about like consulting with the experts, or finding people who has access to people who are able to get better advice, as well as getting started. It's always about that first step. Like the old saying goes, the journey of 1,000 miles begins at the first step. And somehow that first step is always the most difficult.
Yes.
Yeah, but after you get your feet wet, we can talk about bigger things.
Yes.
So thank you for the all the sharing right here today. We're gonna come up to one final part. This final part, but just a brief, short, one or two liners. All right. So we're gonna have a few questions, and I would like to look for 1 or 2 lines from you with regards to this question. So, firstly, what's the best financial advice you've ever received?
It's probably for me, in times of uncertainty, stay calm.
Stay calm.
And don't make any rash decisions. When you're fearful of things happening and you're a little bit scared of what's going on in the market, that's actually the time to look to see where the opportunity is to buy.
True.
When you're very happy and things seem to be going along quite nicely, that's when you need to go and see Vincent, because you need to try and figure out there may be something that could happen. So you need to check your portfolio.
It is. I think it is. It does make sense because, there are a lot of retail investors who end up making poor decisions. And I think people don't coordinate en masse to make these decisions. So why do they make the same decisions? Very often, I believe, because of emotions.
Absolutely.
Right. Vincent, what are the best financial advice?
Okay, this may not be directly related to your conventional investments in instruments, but I would say the best advice that I ever received was from my dad, which is he's a big believer in investing in yourself. So I think Jim Brown has this quote. It's more about in terms of if, let's say, for example, you to get a job, you make a living. But if, let's say, you invest in yourself, you make a fortune. So the key is more about investing in yourself, getting to know what are your strengths and weaknesses, for example. If, let's say, you are very passionate about investments like myself and you want to do DIY, by all means, do a lot more research, do your duty and invest in yourself by probably going to courses or learning more, reading books. And probably on Aberdeen side, I believe they have articles, insights, or even podcasts available as well. Yeah. So that's the part whereby you can do a lot of this learning on your own. But on the other hand, you find that, probably some of these jargons, the moment I see it, I feel like I'm sleeping. On seeing stars, the moment I hear some of these talks about geopolitics and things like that, I do not know how does it exactly translate to my investments. So that's where probably looking for a professional will help. And that is the part whereby you can outsource it to them to help you to tailor the portfolio according to your needs and suit your needs accordingly.
Nice, cool. Next one, describe your investment strategy in 1 sentence. Amit.
I'll give you 2 words.
2 words. All right.
Not 1 sentence.
Oh, this is the shortest answer we have from you so far.
To be fair, you've been due that. I'm due that. I'm going to go for globally diversified.
Globally diversified.
Nice. Okay.
Vincent.
Okay, probably instead of 1 sentence, I'll use food since as
Okay,
Singaporean,
sure.
we like food, right? So I think of it as probably like char kway teow. Yeah, so I'm a big fan of char kway teow. So basically, for those of you who may not be familiar, is like your fried noodles in a way. So it's dark, it has a lot of ingredients. So it's very similar to your portfolio. At first glance, if you are not used to seeing dark colors, you will find that, wow, why is this plate of noodles so dark? It's just like when you're seeing jargons or you're seeing the fact sheet for the first time, I'm totally lost. Where am I supposed to focus on? And that is the part whereby once a little bit like acquired taste, where you are used to it already, you realize that that sense of flavor the moment when you put it in. And even when you go to different char kway teow stores, for example, you realize that some are probably slightly wetter, some are drier, some probably less sweet and things like that. It's very much like you go to different advisors, they all have their own views as well. So that is the part whereby you can see which advisor actually works best with you, understands your needs better, and you can select accordingly. And then after that, if this is your favorite store, you can always go back to your favorite store because they probably already know, wow, I see Jackie. I know immediately I need to add more herb, add more ingredients and dish it out to you. Yeah, so that's the part about working with professionals because they know your taste, they know what you like, and they'll be able to give you what you want.
That's about 53 sentences.
Okay, bye.
But I think the core message is to don't be afraid to try.
Yeah,
because
that's right.
we have to find something that is suitable for us.
Yeah, that's right.
Thank you very much. And finally, okay, 1 book. Share a book that has significantly influenced your investment philosophy.
It's actually thought about this one for a while in terms of, over the years, like what books I'll be brutally honest, I haven't read a lot of books. The books I've mainly read
You've been reading
it's been mainly a lot of research and
research papers,
studying for exams and whatnot. But no, what I would say, there was a book that I read recently. It's not really about investing, but it's actually about understanding people around you and understanding people.
Surrounded by idiots.
That is absolutely it.
Really?
How did you get that? That is that's amazing.
Did you tell him before that?
I did not. I don't know how you've got that. That is amazing. Must have been a very good description.
Yeah.
Yeah, so understanding people around you, and I'm surrounded by idiots.
Amazing book. I mean, like what I found out from reading that book is, one, you understand your own personality traits, and then you can see how your mind processes information and then how you make decisions. But then ultimately what I benefited from the book is actually now identifying, or at least recognizing, other people's personality traits. So they will process the same information differently. And that's not the way I do it differently, but it doesn't mean one is right and one is wrong. It just means we both process information differently. So what I found from actually an investing point of view, listening or understanding how that person has processed that information and using it alongside how you process your information, you get a much broader view. And that might actually help you make an even more informed decision about, whether it's an investment or just even a decision about, where to go for dinner and have fried noodles. It's the same, I think that for me, that book has kind of really opened up my eyes to that. I think I was probably very quick to judge beforehand, but certainly now being able to identify personality traits and how that can then lend itself into making decisions is quite interesting.
So those people are no longer idiots.
Maybe I'm the idiot, I don't know.
How about you, Vincent? What is one book you would recommend?
All right, probably this is not exactly an investment book as well, but I would say this book by Kiyosaki, the ESBI, which is the employee, self-employed business owner and investor. So back then when I was much younger, I'm still young right now, I realized that, I thought the only way to become rich is to do business. Because if you take a look at the list of the top 50 or top 500 for Fortune 500, for example, most of them are in fact businessmen. But there's one unique person that is inside that top 10 or top 5 even, and that's Warren Buffett. If you take a look at it, you realize that his main mode of business is actually investing. So when I read Robert Kiyosaki's book on the ESBI, I realized that we can both be an employee and an investor at the same time. We can marry these two and we can become more well off, I would say, in a way. And especially in inflationary countries like Singapore, of course, CDC vouchers help lah. But it may not be able to offset that high cost of living in Singapore. So that's the biggest reason I find that probably if we were to invest, albeit we can be working for ourselves, like a self-employed like myself, or maybe in terms of working for other people as an employee. That's the part where we can continue to do investment and we can still be better off. We do not need to become like a big business owner, like being the CEO of Microsoft or found another company that can be sold off for millions, like a unicorn kind of situation. We can still do well in life. So that's the part whereby that particular book really helped me open up my mind and say that, investment is really the route to go, and this is something that we should not be staying away from. And in fact, we should double down and see how we can actually do this better.
All right. Thank you very much. So with this, we have come to the close of our conversation here today. Thank you very much, Amit, and thank you very much, Vincent. Once again, for all our viewers, right? Amit is a fixed income investment specialist with Aberdeen. Now, you might not be able to get in touch with him so easily, but how you can get to hear from him is, of course, through our wealth manager, Vincent. And of course, if you would like to find out more, we have information in the
you can drop in the comments
captions,
box.
right?
Yes.
Yeah.
Yep.
So you can get in touch with Vincent and find out more, or even, just have a conversation with him. Again, my name is Jackie. It's an absolute pleasure. I hope to see you next time at the Affinity Exchange.